And welcome back to another episode of Irresponsibly Short.
You're
I'm
so
here.
bearish, dude.
Well, it depends on your timeline there. I am here with my dark friend,
Yeah, sorry, I haven't fixed the
Eric
lighting situation
Johansson.
yet. Sorry.
Yeah, this pod has always been a bit of a work in progress, but we'll just keep chipping away every week.
Room for upside, just like the markets.
Yeah, lots of room for upside, also some room for downside. It's an interesting time. So, yeah, to recap, I guess we talked last week, I think, a lot about the upcoming. Would you call it a window of strength?
Oh yeah. Chem's window of strength leading into March OPEX.
Yes. So we got March OPEX major options expiration date coming up here. The end of this week, right? Is it the 21st?
21st. Yep.
21st. Nice. We're recording this on Tuesday, the 18th. So we've got a FOMC tomorrow. And I think you and I were both feeling constructively bullish last week, at least for a trade in pretty much all markets. That sound about right to you?
Yeah. I was feeling like I wanted to buy something and I wanted to go safe, so I was thinking about buying the Mag 7. That doesn't look too
The
good.
Mag 7, or somebody in one of my group chats just recently coined them the Bag 7.
Oh yeah, I was calling them the Lag 7.
The Lag 7. Yeah, they're not looking too hot. But you were buying some long-term bags in those, huh? You're just like,
I
this
felt
is a
like
good enough price.
I felt like when you can get a 20% dip on Amazon and Google, you kind of just take that and ride it for a while.
Yeah, I feel like that's a super, super reasonable long-term mentality. If you're in it for the long haul, you're not trading on leverage. It's good enough for me. I still don't own any
Stocks.
real stocks.
Yeah. Yeah. You prefer magic money.
Magic money. Yeah, no. I mean, even my coin holdings, we talked about, I reduced them heavily a month or two back. So I'm stonk light right now, stonk light, cash heavy. But trading the perps. I'm long some perps at the moment. Mostly long Bitcoin. Had some nice TPs last week. Basically been long. We've been long Bitcoin and Fartcoin in the Discord. I think we
Yeah.
talked about that last week.
The Lord's barbell.
Yeah, just getting getting both ends of the barbell there. Bitcoin's been maybe the strongest asset other than gold. It's kind of hard to beat gold strength. Unfortunately, I don't own any of the boomer rock. But it's been relatively strong on a relative basis,
Yeah.
And I think price action last week was like fairly constructive, and I think we're pretty well positioned going into the FOMC tomorrow. We had a interesting little Bitcoin close last week. You can see we basically swept this is the February low here, February low at like 78K. And we also swept the low of this super nasty expansion candle that we had. And then we closed the week bullish. So I'm bullishly biased going into the rest of this week, going into next week after or so. Obviously, Trump could do or say anything. We got to caveat everything we say with Orange Man could do something. Orange Man could do a thing, unfortunately.
Yeah, it sucks.
But I think the setup's good. I was telling the Discord yesterday that I wanted to buy some blood heading into FOMC. And so I actually just bid a little bit here at 81K. Think we could definitely get 80.7. I got some bids in. And even this low here around 78.8, I think are interesting spots because I'm just biased towards higher. I don't know how high we actually go, but like
would this be for a shorter term trade, or is this like filling long term bags?
no, this is just shorter term stuff, because I'm sort of trying to play a balance. We've got the CME gap here around 87K that I think we could bounce to. But I'm also open to the idea still that we come back to the mid range of this last kind of zone of supply here, maybe even take out these highs around 100K. Like, so that's still a scenario I have in my mind, and I think it's on the table depending on how tomorrow goes. We also had a meeting with Trump and Putin today, and
How'd that go?
I've heard people say constructive things about the meeting. The NASDAQ is not reacting constructively at the moment. It's down nearly 1% on the day, and it's down more than it was a couple hours ago. So things seem to be trending in the wrong direction on that. But I always think that's sort of more of a looming bullish catalyst than it is bearish catalyst at this point. I think a lot of the catalysts are now positioned in the opposite direction because the market has sort of like absorbed so much fear, done so much selling, done so much hedging already. Not that I think that this is over. I do think that we ultimately, see lower, sometime this summer probably, and hoping that that's a brief dip, but still kind of on board this Besant wants to force QE thesis. And as long as that's the case, it's like hard to feel good, holding any of these mega risky assets for more than a trade. And I think you probably are still of the same mindset.
Yeah, mostly cash, mostly just being defensive, trying to protect and preserve wealth, not really trying to grow it so much.
I like it. If I zoom way out on Bitcoin, I can do a little bit of candle science here too. The most notable thing we had happen this year was we swept the high of the January 24 yearly candle. And, these yearly candles they're a big deal. You sometimes get significant reactions off of them. And although we've had a, pretty, I don't even want to say it's a nasty sell-off in Bitcoin terms and in TradFi terms, it certainly was nasty. We went down about 30% or so from high to low. But in the context of this candle, not like a huge pullback, I think it's highly, 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 highly unlikely that we take the high of this candle and then take the low of this candle this year. So if you want to put it like a mental floor at 38.5, it's probably a safe thing to do. You don't usually see price taking both ends of a candle like this. I don't think Bitcoin's ever done that on a yearly candle, right? So an interesting thing I'm sort of framing myself to at this point is just the mid-range.
Mr. Mid-range.
Mr. Mid-range. Just the mid-range of the last candle, right? And that mid-range to me is interesting because we've got the prior all-time high here. And if we zoom in a little bit, see what that looks like structurally, we've got the high of this range here. We've got a little demandy demand over here. So yeah, I'm pretty optimistic that maybe we can find a bottom around this sort of 70 to 73K region. And I love Bitcoin in the long term still. So that's still my mental model over the next few months.
So fill long-term bags there in the low 70s.
Fill bags there. I think got to be prepared for the idea that this could go lower, right? Because I think if it doesn't find support there, then I think we're going into the 50s, the mid low 50s probably. Just hard to predict all this stuff so far in advance with all the differing crazy shit that could happen in the world. So strong plans loosely held. I don't know.
I like it. I mean, I would definitely feel comfortable buying Bitcoin in the low 70s and just like holding that for the rest of my life. Maybe like I'd feel fine.
Yeah, it's interesting to me because now I'm thinking of I'm thinking of cap gains. I'm thinking years out at this point. I'm thinking of the setup and all the world governments, all the incentives for the politicians. It's all aligned very well for Bitcoin right now. So looking forward to loading the bags. On a related note, I know you wanted to talk about a Bitcoin adjacent trade, a MicroStrategy adjacent trade. I mean, you wanted to give me an overview on MicroStrategy's new preferred stock.
Yeah, preferred equity. This is like a realm. Preferred equity. People don't really play in this domain very often, but I've dabbled in the past, so I know a little bit about preferred stocks. MicroStrategies is called STRK. Mm-hmm. So at a high level, preferred equity pays you a a dividend or like a coupon, just like a bond. And it's kind of priced like a bond. It's like issued at a par value, and it yields a certain percent at issuance. So this one has STRK has a $100 par value and paid 8% at issuance. So STRK now has traded down. It's at like 85. So your yield's higher if you get in now. It's like a 9.5% yield. And like the analysis you're doing is really just like, do you like 9.5% yield? I think I do compared to like what's existing in the fixed income market. But that's also dependent on a few things. The risk in preferred stock is like, is the company going to go bankrupt? That's risk number one. If it does, preferred equity gets wiped out because it exists lower on the cap structure than debt does. So like preferred equity kind of is like equity in a downside scenario, it goes to zero. But if you like MSTR, like I do, I don't think it's going to go bankrupt. Then a 9.5% yield's pretty good. The other thing you can look at with these, and this is true with bonds, but it's like definitely true with preferred stock, is you have like interest rate risk. So like a 9.5% yield, I think is good today with interest rates where they are. Mm-hmm. But if interest rates spike, then something like STRK, the price will go down because the yield has to be much more attractive than like a risk-free yield.
Okay, so I have questions because I am admittedly a bit of a preferred stock newbie. Everything you just described to me sounds basically like a bond. It sounds like it's priced around par. And as the price here is traded away from par, it looks like we're like $86 right now.
Yep.
The sort of implied rate goes up.
Yep.
All right. So you said this is basically 9% right now?
9.5%, yeah.
9.5%. So this pays you like a monthly dividend?
Quarterly, yeah.
Quarterly dividend. So quarterly you're getting 9.5%. Is there like a duration? Like what's the duration?
Yeah, the duration on these ends up being like infinity because these are like perpetual preferred. So you can get this yield forever. So the duration, like the interest rate risk that I described, is like extra important on preferred equities.
Fascinating. Okay, so yeah, so this is a concept I'm familiar with in bonds because as you have a bond that, like, say you have like a 100-year bond. The price of that bond is going to respond like wildly differently to changes in the underlying rate than like a 3-month bond because you have all of this duration.
Precisement. Right? Perfect.
See. Okay, so you're basically saying I can get 9.5% into perpetuity right now by buying this thing, and my main risk is MSTR bankruptcy.
Yeah, and interest rates rising. So those are two main ones. I think this thing will also trade sort of according to Bitcoin, right? Because like if Bitcoin dips down to the low 70s, like you're talking about, or further, then that puts MicroStrategy's business model more at risk. So the price of these preferred equities would probably dip further. And I think like maybe now is not the exact time to be buying this, but at some point it's going to be really attractive. The other thing I want to mention is that you get some equity upside in these preferreds.
You do?
Yeah, they're convertible at like a 1-to-10 ratio. So it's like, it's not great equity upside, but with the price at $8.85, you can convert shares profitably if MicroStrategy was to go above $850. So you get equity upside. I mean, it's far away, but
so MSTR goes above 850, and then all my shares just convert directly into equity, or the option.
Choose. Yeah.
Okay. Interesting. So you're. I mean, that's not that far away if you're bullish on Bitcoin.
It's like it's not that far away from particularly where like the debt holders sort of like strike prices. The debt holders that are getting 0% coupon on the convertible bonds, their strike price is like $6.50. So I feel like capturing 9.5% is pretty nice compared to what those guys were getting.
Why would you not want to roll it into equity at 850?
I guess if you like the yield,
keep getting the yield.
Yeah,
interesting. I mean, it's a fascinating play. I mean, it's obviously a risk in the longer term. I think that rates spike. In the shorter term, that seems a little bit unlikely to me, given what's been happening.
I mean,
in the larger market,
if you like the TLT trade and you're like okay with that duration, like this is even a more magnified version of that. Where I think if like the yield curve goes down, then this thing would easily just jump back to par, and you could like make money on that trade alone without even holding for the dividend.
Yeah, except on this trade, you've got your Bitcoin price risk as well.
Right, of course.
Whereas TLT probably does okay in some scenarios where Bitcoin goes to $28,000. This thing probably does not.
Yeah, well said.
All right, cool. It's a interesting idea. Interesting idea. I like it. Really making me think outside the box here. I got something for you that I wanted to talk about, and this is based on a tweet I saw from our boy Martin Shkreli, who's now just apparently a professional short seller.
Yeah, he's a hedge fund man now.
Yeah. So let me pull his tweet up on the screen here, and there we go. All right. So Shkreli said, ACN is a good short, insane valuation. AI will take a bite out of both of their main businesses over time. It's just an old, dead, bloated company that will shrink over the next decade. ACN, for those not in the know, this is Accenture.
Management consulting firm.
Yes. Yeah. So, I mean, consulting's always been one of those funny industries to me. I went to an Ivy League school, so I feel like 90% of the people I went to school with either went directly into iBanking or consulting. So know a lot of guys who went over to Bain, McKinsey, Booz Allen, whatever. Everybody.
Yep.
Everybody I know. And it was always a funny thing to me because I would just talk to my friends and be like, oh, these giant corporations are paying millions of dollars to have my 21-year-old buddy like make some PowerPoints on something, and it just seemed so silly to me and so inefficient. But obviously a huge industry. And when I saw this tweet from Shkreli, I was like, oh yeah, this does actually seem like, in retrospect, the exact kind of thing that like AI could have completely replaced. Like everybody I knew could have definitely been replaced by an AI chatbot, I feel. So it got me kind of thinking about this. And I went to AI to kind of get some thoughts on this. I went to both Claude and the new deep research function of ChatGPT, which I don't know if you've been playing with this at all. Have you?
Deep research? No. Didn't they just roll that out to the $20 per month tier?
You get like a fixed amount of searches per month. Okay. And then $200, I think, gets you the unlimited. Really good. I mean, look at all of the stuff it gave me here. Just goes on and on and on and on and on. I mean, this is gold, gives you all the sources at the end, right? So, I asked it to basically formulate a detailed short thesis on how AI could destroy the business of ACN, and some analysis on why this might also not transpire entirely like you believe. So, I mean, there's a lot of like really interesting nuggets in here. I think for the purposes of kind of TLDRing this for people, there's this interesting sort of double-edged sword going on where, we see in development, for example, on the one hand, AI has like sort of destroyed some development jobs, undoubtedly, right? On the other hand, it's made individual developers, by some estimates, like 100% more efficient.
Yes.
Right. So on the one hand, there's some like, well, there's some push and pulls going on in the market here when you talk about ACN. And on the one hand, you have AI basically like driving like efficiency gains to the moon, which means from the perspective of like an ACN, like they could deliver far more results to a client for like a far lower cost, right? Because they're going to be able to process all these things that they do, efficiently with less manpower, in the same way that like a dev is able to kind of like process all this code more efficiently and with less manpower, right? The problem then becomes that the bread and butter of these companies is their billable hours, right? So you're sort of cannibalizing your own business, right? And then you're either hoping that initially it could be good because you're maybe giving the same results to the company, and then your input costs are far lower. Like maybe you've got like one intern doing the whole entire project instead of like 10 of your higher end consultants, right? And initially that's great because you're like, wow, my margins went from 80% to 99%, or whatever their gross margins are. But over time, of course, like the companies themselves that are contracting, companies like ACN, they're aware of what's going on in the markets, right? And then you've got little software companies sprouting up in the background, trying to sort of cannibalize ACN's market share, because their pitch is like, hey, you can do all of the stuff that these guys are doing for you with like all this manpower with like our little AI model over here, and instead of you paying $2 million for this, we'll do it for you for like $20,000, right? So now the companies come back to ACN and they're like, we're basically going to demand some of that margin that you're getting, right? In the form of like, yeah, maybe we'll keep working with you, but we need better pricing because we know what's out there now. And then you have margin compression going on and all these other sorts of nasty things that you don't like seeing. You don't like seeing in the P&L there.
Yeah, I think you kind of like accurately described how I'm feeling about it. Is that it's probably going to take a long time for their business model to be disrupted, Accenture and Bain and McKinsey and the rest. But like, I'm also wondering if Jevons paradox comes back into play on this one, where like efficiency gains just means more demand because there's like more things that they can help you solve. Like one thing I also lean to is like when you're spending a bunch of money on a contract, having a personal touch there becomes important. I see this like in like investment management still, like in my field, when you're dealing with somebody's entire net worth, like they don't necessarily want to entrust that to a robot all the time. They want to have somebody that they can talk to and bounce ideas off of. So I think that's another thing I'm thinking of. I'm really thinking that in the 1 to 2 year time frame, we might actually get a pretty nice entry if the FUD becomes so large on these names that they think the business is doomed, and then you'd probably see at least a short term window of opportunity to buy one of these things. I think there's going to be probably increased demand as AI agents, like that whole narrative transpires. You're going to need somebody to implement that. I think Nick on Alfalfa was talking about companies like ServiceNow or Salesforce being those kind of like service providers that help other businesses implement AI agents. But I feel like Accenture could also be one of those, and maybe they see a tailwind in the 1 to 2 year time frame.
Yeah, I like this idea that at some point there is going to once again be this like kind of premium on human touch in a world where maybe everybody just gets so used to interacting with AI models and robots and whatnot. And some of these companies, I think, for sure might spring for that. It's just sort of a question of like, when do you get there? And in the meantime, like what happens? Like how many people are you firing? How many cost-cutting measures are you implementing? How are you just completely revamping your own business to sort of take care of this new world where you're kind of doing consulting, but like within AI, right? And you're using the thing that's kind of killing you. And how do you implement that into a business model? Like, and how long does that take? Versus, of course, like what's already been priced into the stock over the last few years. So it's definitely not a simple LOL stock go down thing. I think a lot of things can happen here.
Well, how does the stock look? I mean, have you looked at the chart? Is it dying?
Of course, I've looked at the chart. Right?
Is the stock dying based on this FUD right now?
I like the charts because I think they visually encompass like a whole, like all of this complexity kind of gets reflected in price. Yeah. And I think the stock could tell a lot from the chart. So here's Accenture. Let's zoom out on this bad boy. Here's your yearly chart. So a couple of things strike me on the yearly chart. You had this big expansion candle and then an immediate expansion candle to the downside.
When on the calendar was that? Like,
so this is a 2021 expansion and then 2022, right?
Okay, so that was probably prior to this whole fear about AI even.
So it's very interesting to note when ChatGPT was released, right? Which was basically here.
Okay, so the market identified that as a risk.
Yeah, I think like precisely right about there.
Okay.
And this becomes even more obvious on another chart that I'm going to show you. But this is the USD chart, right? So as a trader, I'm looking at these yearly lows. At 241, we're sitting here at 322, and like to me, this looks like a foregone conclusion that we take those lows. So it's just a question of like, how do we get in? How do we manage our risk? Obviously, over the past few weeks, like you can see, there's been like a pretty substantial sell-off already. I mean, we've just absolutely nuked here. This is
that's kind of just like beta, though. Like everything's kind of down.
For sure. And I think a lot of stuff looks like this, but nonetheless, it's tricky to position into a trade when you've already nuked. You're kind of getting towards the bottom of like this little range here. Frequently, you get the bounce back up there. So if you kind of do like a risk reward on that, what does that look like? From this high, it's not mega enticing. It's like a 1-to-1, right? But it's a good looking 1-to-1. I mean, the odds that we come back and just finish our business and take this yearly low versus like we make new highs from here. Like I'm taking the downside on that all day long.
Well, I like this. If you're like building a portfolio, is this one way that you would look to sort of like hedge out risk, is like looking for short opportunities on individual names like this, as well as like going long the things that you believe in?
For sure. I'm definitely short some stuff that I think is trash right now. Just as like some of it naked short, just in dollar terms, right? Just because I want some of that downside exposure because it's going to be good for me in a world where like stocks start dumping and I still have this Bitcoin in my portfolio, right? And I don't want to get completely nuked when that happens, right? So it's nice for the downside exposure. What I ended up doing in this trade, and I've decided to put on like half of the position at this point, is I actually set this one up as a pair trade. And the pair trade looks interesting. There's a couple things you could think of it as a pair trade with. One is the NASDAQ, right? Because you can kind of view this, I think, as like this is basically, the NASDAQ is a technology index, right? It's basically an index of AI at this point. So you can view a company versus the NASDAQ as sort of like their relative benefit of AI versus the AI benchmark. I think it's kind of an interesting visual. And if you kind of zoom out, you can kind of see what the market thinks of that at the moment, right? Like this is a horrific looking chart.
So is this ACN against NASDAQ?
Yes, this is ACN against NASDAQ. And it is just this like long, shitty distribution top, basically. I mean, this is like really, 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 really gross. You could see this like kind of like just lower high, lower high, lower high, lower high, lower high. And now the momentum is like really shifting because we had these kind of deep retraces back into the zones. But now we're getting these like big impulsive moves. And if we pull up like a 3-month chart, right, you can see all sorts of bearish imbalances on the 3-month chart, right? Like this is just indicative of very strong selling.
Man, this really puts it into perspective. I like this a lot.
Right. So I think pairing this versus the NASDAQ is like a pretty interesting trade. And I think it gives you like a different kind of invalidation in terms of like, okay, like I want to figure out how to get into this position, but like it's so high back to the high. It's like a lot of risk for me to take on. But if you structure it as a pair trade, like I think like you can kind of isolate what you want to be isolating in the trade, which is that this company is just simply going to underperform relatively, right?
So when you
because you could go short and it's a bull market and everything goes up.
So when you put on a pair trade, typically you would go long the NASDAQ and short Accenture in equal dollar amounts, right? That's like what the pair trade typically is. But I think
so. Go ahead.
I guess what I was saying is that I think for most folks, like you don't need to like put on the pair trade necessarily, because I think most people have exposure to the NASDAQ already. So you can just like tack on Accenture as the short.
That's definitely one way of looking at it. Like if you're really, really long stocks to begin with, because it's your whole retirement account and you're a trader, you could just take these trades. So I mean, this is similar to what I do in crypto, right? Like when we're in bull markets, like I am sometimes shorting coins, knowing that I'm in a bull market, knowing that everything is going to go up and the market is going to pull these coins up. But I'm doing so knowing that it's sort of like hedging out a lot of the risk in my portfolio. And then I open myself up to these scenarios where when the market dumps, this thing kind of like saves my overall portfolio. And there's some scenarios where the market goes up and everything I'm in goes up and the stuff you short goes down, which is like the golden thing. So I think that's totally legit. I personally took it as a pair trade. And although you can simply say like, okay, I'm going to short of ACN and long $1,000 of the NASDAQ, right? The better way to do this is to sort of weight it by the beta of ACN to the NASDAQ, right? Because if you have a stock, for example, that has a beta of like 3 to the NASDAQ, like, right, it just moves like wildly versus like the benchmark, then shorting like equal parts, shorting and longing equal parts isn't going to exactly give you the result that you desire. Like you can end up in a scenario where this thing just goes way up, even though it's bearish because like the beta to the NASDAQ is so high and the NASDAQ goes up a little bit, right?
Yep.
So in this instance, like I looked it up, ACN I think is 124% to the NASDAQ, right? Okay. So basically for every $100,000, you short on ACN, you want to be long $124,000 of the NASDAQ, right? So that's kind of like the starting point if you want to put on the pair trade. But then when putting on the pair trade itself, like there's a bunch of ways to skin this cat, right? Because you can take the short side in 2 main ways, I would say. Like you could just outright short the stock. And when you do that, you got to check with your brokerage, like what is the cost to do that? Like what is the interest? Like there's some stocks that might cost you like 20% a year to short.
Yeah, the shitty ones that are going to go down cost you a lot to borrow.
Right. And so that carrying cost will like eat you alive if this is like kind of like a longer term trade, which I kind of do view this as. This seems like a really interesting, like multi-year thing to have in your portfolio, right? So if the carry costs on this were enormous, that would be a bad play, right? So you could short by just shorting the stock. You could also short via options, which is interesting. And then you kind of have 3 different plays, broadly speaking, on the options. You can short, deep in the money, you can short at the money, you can short out of the money, and all of those have their own individual drawbacks, right? So if you were not expecting this to be just like I think it's just going to dump next week and there's going to be some nuke that the market's not pricing in, then shorting, like everybody wants to put on this trade, like who doesn't know a lot about options, by just like buying deep out of the money, right? Like, it's going to go down a lot, so I'm going to buy deep out of the money. But as you know, that introduces a whole bunch of variables to the trade that is maybe not something you had in mind, right? You got to be really on point with the volatility. You got to be really on point with the timing, right? So as you go like deeper into the money, those options, they behave more like the underlying stock, right? So if you wanted to take like a really long-term thing on this, you could go deep in the money with puts. Your leverage is going to be a lot lower, right? You know, your kind of capital requirements to put on the trade are going to be higher, but you're going to be less exposed to some of these elements that maybe you weren't planning on when putting on the trade.
Yeah, I like that. I like the way you explain that. Yeah, I think it all depends on your outlook, right? If you expect some sharp decline, then nothing's going to pay more than buying out of the money puts. And it kind of just depends on how you want to play it. You want to get a lotto ticket, or you want to just kind of like hit singles?
Yeah. And to me, this isn't a lotto ticket. To me, this is just like a slow, systemic sort of collapse, probably for lack of a better word, that we probably see play out. And so I ended up just naked shorting I guess not really naked. It's a pair trade. I'm hedged, but I ended up just shorting the stock instead of doing options on this. It was like 0.25% annualized. So yeah, something
that's like the sort of base fee. So it's just kind of like a normal stock to short.
So something pretty low. So that's $250 per 100K. So it's pretty.
Yeah. I like this. This is like another name that I would like to add to my list of things that I would sell out of the money calls on too. Because if this does pump, I think it's probably going to be short lived. I'll probably collect premiums along the way. And then if I end up having to short at a higher price, I'm okay with that.
Yep. So what I ended up doing though is not taking the NASDAQ trade. I ended up taking the trade versus the S&P, which I think is sort of like a more direct representation of I think the stock is in the New York Stock Exchange. Mm-hmm. So it's, I think S&P is like a closer analog to it, just in terms of like shorting it versus the benchmark. As I say this out loud, I'm actually wondering like if maybe the NASDAQ was like a more interesting play, just because I am kind of in my mind like betting sort of directly on the relative benefit of AI between this company and the tech benchmark. So I may actually reconsider that. But the SPY chart is very interesting because you can see very clearly when ChatGPT rolled out on this. I mean, it was literally the ChatGPT launches and then the market manipulates, and that's all she wrote.
Wait, this is ACN against SPY?
This is, yes.
Okay.
Yeah. So from a price action perspective, the market is not and has not been for quite some time feeling good about this. I mean, this is just a pretty substantial nuking here. I mean, yeah. So on the 6-month chart, you can see we get a very clean imbalance there. This is your bearish fair value gap. So it's worth asking, like, what is this candle reaching for? So like a safe trade to me is, the mid-range of a demand zone like this. That to me is what the candle is reaching for. And this is generally a good kind of like basic trading technique, right? You see a manipulation, price starts moving, you get an expansion, right? You wait for the retrace, you get a retrace into an imbalance here, and then you position and you say like, okay, where was this move going to? Has this move gone to its target yet? If no, then I want to position on the retrace in the imbalance. And then I want to take the move back down to the rest of its target. Now, there's no reason it has to stop here. This is just sort of like a logical TP. Mm-hmm. But the trade becomes a lot more easy to frame because you can probably say to yourself, like, okay, this monthly candle that tagged the imbalance, that can be my invalidation. I don't have to put this thing like way up here.
Yeah.
Right. So I can be safe, put it there. And now if I'm taking that down to the mid range, now you got a pretty clean 2-to-1 trade there. And that could just be like an initial TP or, TP half the position or 75 and leave a runner or whatever you want. But that gives you a healthy move. I mean, this is still like this is a 20% move.
Damn, I get so greedy because like I want the stock to go back into the top end of the range before I short it. Like I like this idea, but I feel like I just get too greedy. Like I don't want to short it right here necessarily.
Like you want price coming like up here?
No, at least just to the top of the mid range that you pointed out.
Like back in.
Yeah.
Well, I would have liked to take the short here, but didn't see it yet. Right. So you got to kind of think about.
Maybe this becomes like the level where I sell calls or something,
Yeah. I mean, selling calls above this ratio, right? I don't know if you ever do you ever do pairs? Like ratios for calls, like you like sell calls on the ratio itself.
No,
that would be kind of interesting. I'm trying to think how you would do that. You would be probably buying S&P and then selling.
Yeah, you do the same thing just on the options, but I think you would have to look at delta instead of beta to make them tie out.
Yeah, but that'd be interesting if you figured out how to do the how to make the math where you're basically selling like a call ratio of the ACN SPY. Then this level here I think is a good example of an interesting level to do that, because price is probably going to come down here before it goes back up there. And that's how I view this. So interesting trade.
I like this.
I am open to the idea of this going higher and putting more size on. I'm kind of doing the Stan Druckenmiller thing right now, where you put the position on and you.
Dude, I've totally adopted that style where you get in immediately and then you really like research it afterwards. You don't want to miss it.
Yeah, and this is like a slight variation on that when trading, right? Like sometimes you spot a good trade, but price isn't like at like a favorable place. Like we're here right now, right? This is like 1.5 to 1, right? I wanted to get in up here at 2.5 to 1. So what do? Oftentimes the play is to get into 10, 20, 30% of the position immediately. For me, that sweet spot's usually like about 30%. And then you have the trade on, so you don't have FOMO, which means that you're not going to do anything stupid because you're not missing out on anything. If the trade just runs straight to your target and you take no drawdown, like boohoo, poor guy.
Yeah, you will. Yeah.
And then if the trade comes back to the area where you wanted to enter, you have plenty of size to enter on. Like if you're risking 1% of your account, like to a move here and you enter with 30%, then you've got the whole another 70% of size to put on there. And then you can get your average risk reward substantially higher, from that point on. So that's generally how I approach it. There's tons of, you don't spot most trades at the right time. Like most of the time you're like, oh shit, that's a good trade. And I totally missed it. And I think it's running away without me. So that's how I approach it.
Well, this is a good one to keep on the radar. I want to play along.
Yeah, it's just like an interesting thesis in general that like kind of expands across like a lot of different niches. Like we're in this like very interesting time where we're just probably going to see like a lot of creative destruction happening, right? There's going to be a lot of Kodaks, right? Yeah. And it's kind of like with what we have in crypto right now, where we just have all this stuff that's actually worthless, and the market kind of knows it's worthless, but like there's still this issue of flows. Like stuff doesn't just go to zero. That's especially true in stocks with the way that a lot of these institutions move. They go slower. And as like a small player, like it's a lot easier to, I think, like hop on these trends. I think in TradFi, you have a lot more time to hop on these trends. Like there's stuff in crypto that I feel like happens in a matter of like hours, and you're like, damn it.
Yeah, and like Accenture is probably still part of the S&P, so it's like getting positive systemic flows every 2 weeks from people's paychecks.
Yep. And then there's probably a point where these things drop out, and that is interesting. That might be interesting as well. Like what are some companies that are on the verge of maybe dropping out of the S&P that fit a similar thesis of like, okay, this new paradigm of technology is going to just completely evaporate their business into nothing. So Yeah, if anybody's got any ideas of stuff that would fit that bill, I'm all ears. Would love to, hear you guys drop it.
I like this
drop
idea
it in
of
the alfalfa Discord. Yeah, I mean, I'm really excited with it. I've already noticed such a vast improvement in AI's ability to kind of do this sort of analysis on the sort of fundamental side. It's perfect for me because like I already do all the technical stuff on the chart, and I don't necessarily need AI for that. But this can give me like this confluence, right? Like immediately in a world that you play in that I don't play in it at all. Like I don't consider myself to be an analyst. That's not what my edge is. So it's really cool to have something that can be like this little analyst sitting on your shoulder to kind of see if there's like a match for your magic lines over here with like what's actually going on with like the real nitty gritty of the business.
Yeah, man. And it'll continue to develop and get better. So
absolutely. It's going to be wild to do this show a couple of years from now, God willing, and to kind of see the crazy shit that we're doing with these tools. So it'll be fun. Anyway, let's wrap this with one more educational discussion here. I wanted to talk about a very important topic that is near and dear to my heart, and one that I try to hammer home to people in the Discord. Like if you join Magic Lines, the very first post is about risk management. And
yeah,
this is something that I've been doing for so long that it's just sort of like a second nature thing to me. And I forgot that this isn't actually a thing that most people think about at all. And I've been reminded of that in seeing some of the conversations with people, and like I'll have people, hit me up and be like, "Hey, I'm like down so bad on this. Like, what do I do? Is it going to go back up?" And I'm like, "Well, if you're asking that question, you've already done fucked up." Because whenever you get into a trade, like rule number one is to think about the downside first. How much do I lose when this goes wrong? Everybody does the opposite. They go like, "Oh, wow, how much money am I going to make when I get into this?" And it does like 100x or whatever. And they do all their sizing and all their fantasizing about the outcome on the bullish side. And they don't start thinking about the downside until things start moving against them. And that's precisely the wrong time to do that. So whenever you guys get into a trade, rule number one is to figure out, where am I wrong on the trade? Where am I getting out of the trade? And how much do I lose when that happens, right? Your liquidation price is not your risk management. I think a lot of people think that like, oh, you just go levered long, and if you get liquidated, that's it. That's just it. That's not how it works, guys. Like, people aren't sitting there with $10 million accounts and then they're just like, "Oh shit, I got liquidated. Damn. Guess I'll open a new $10 million account." Doesn't work that way. So that's my intro to the discussion. I want to kick it over to you. I know that you do your own kind of version of risk management. It's a little different than what I do because you are working with a little bit different instruments to me. But curious your take, how you think about this, like what you do that works for you. What are some nuggets that other people can kind of take into their own trading?
Yeah, I think it's very context dependent. You kind of just alluded to that. I think there's like, let's just talk about one archetype. There's like long-term holders who just buy the index, right? Like, I don't think you really need to risk manage that. You're just like holding that forever. Mm-hmm. I feel like that's fine to not even really risk manage.
Yep. More investing.
Yeah.
The more investing, the less trading, I think. It's a useful heuristic is that you don't need as much risk management.
Yeah.
There's still some risk management in investing.
Yeah. Like the example that I shared earlier in this pod, like buying Amazon and Google when it's 20% down, like, am I really going to like set a stop loss on that? No, probably not. Like I'm just investing in those. I do it more when I'm trading options. And the way that I go about it is probably a little different than how you risk manage on perps or in coins or something. And the way that I typically do it is like I plan my exit in advance on the upside. So if I'm buying a call, I'm selling an out of the money call on top of that. And that can really fund like so much of the call, the long leg, that it ends up protecting you. Like on MicroStrategy, for instance, there was a time where I was long MicroStrategy calls, but I sold MicroStrategy calls out of the money. And I was wrong on that trade. But the short leg protected 80% of the downside. And I just put those on at the same exact time. And I just set the out of the money call at the level that I was like picturing MicroStrategy to go. And, you know, of course I was wrong. It went down, it didn't go up, but I only lost 20% on the trade, which is in options land. That's like pretty good risk mitigation.
Mm-hmm. Now you do some of the most dangerous stuff that exists out there, because you do some like just naked put selling, right?
Well, I do naked call selling too, so that's even more dangerous.
That's true, because they're unlimited.
Yeah. Right.
Unlimited to the upside. Okay, so I mean, let's talk about that, because that to me is like the most dangerous thing I could think of, right? You're basically exposed to infinity in the other direction.
Well, let's talk about
how do you approach
let's talk
that?
about naked put selling first, because I think this one is like
probably easier, yeah, because you know where it can go.
And I don't think like people are going to be selling naked calls, you know, so I don't think we need to really even talk about it. But if you're selling naked puts, I view it as like your downside is the stock goes to zero. Mm-hmm. And that's the same downside you get if you're just like holding the common stock. But I'm typically selling out of the money. So my risk is actually lower. It's actually safer than just buying common stock. The only time where it isn't safer is when you oversize, you like overexpose yourself on the number of contracts.
Yeah, I was going to say like that could definitely be a lot riskier, because you're maybe selling 10,000 times the size of what you could buy.
Yeah, and
just with the common stock.
In our Naked and Afraid channel, poor Shrank just went through a liquidation event as he was selling puts, and price was going down. So we got margin called. But this is something I've been through too. Like you just learn the hard way to size properly, because when you're doing this game, the sizing is what really gets you. And, you know, like the way that I do it, it's like just slowly accruing your wins and stacking up those wins over a long period of time, which ends up being a nice yield. But it doesn't feel like a lot of money on a weekly basis. You know, if I'm making like $100 on a name in a week, people are like, well, why the fuck am I doing that? But then you just do it, like you just do it over and over and over again, and it just stacks up and it compounds. And, you know, like that strategy can return 30% on an annual basis. So that's the way I do it.
30% is a good return. That's nice. That's nice. But selling premium is so seductive and dangerous to people, because it's like the opposite of you know how humans are, we have like loss aversion, right? We feel an equivalent loss as being like twice as bad as a win.
Yeah.
Or more than that for some people, right? So in the other direction, like we get biased to feeling really good about getting like frequent, predictable, like low hits of dopamine, which is what you get when you sell deep out of the money premium, right? You're like almost always winning, and it's just like money coming in, money coming in, money coming in, money coming in. And then the downside is like out at the tails. And like humans, in addition to being sort of like asymmetric in how they feel loss versus gain, are also very, very bad at evaluating non-linear outcomes, right?
You're very right about that.
So the tail risk of options is very non-linear. It's just like this like kind of fat tail thing way out there on the bell curve. And we have a very difficult time like conceptualizing what that means, you know, what that means, like to have like a 1 in 1,000 outcome happen or something. But actually, if we do this for 10 years, like it probably will happen. And then we will blow up our entire portfolio. That's like very difficult for people to.
Well, I'll tell you how
that
through. Like that phenomenon that you're describing is very real, and how it manifests itself in practice is that you typically see like greed take over when you're like, because I win 97% of contracts that's like my historic level, like there's a little voice inside you that's like, do more, do more, do more. And you kind of have to just like learn. I've learned through experience to not do more and just like take your little wins, stack up your wins. And like when a loss does happen, you don't just get steamrolled.
Do you think like the vast majority of people should just like only be selling like spreads so that there's like or is there just not enough money
I've thought about this a lot because like I haven't launched the product, but I was thinking about launching the product, and I would like the analogy I was making in my mind was like when you watch like a workout video, like an exercise video, they have like the exercise, and then there's like modifications, for people who are like don't want to do that much. They're like, okay, so here's the modification. You just do this instead. I feel like the spread that you're describing is like a very simple modification for people who have like a lower risk tolerance. It still makes money. It's less money. I mean, you can juice it up higher. Is one way to do that, because you like limit your downside with the spread.
Yeah, the spread is nice because your downside is fixed and knowable, right? And so you could be like, okay, well, and sometimes it's sobering because you're like, wait a minute, if this goes wrong, I'm blowing up $20,000 and I'm making $200.
Yeah, exactly.
Right?
Exactly. So. I don't like the spread typically because like my way of mitigating risk is not like through capping it with like a spread. It's mitigating it through size and like knowing that I can be long the name. Like if I actually lose this thing, like I'm selling puts on things I like. Like if I sell a put on Amazon that's 50% down, I'm like, okay, that's my downside is I have to buy this thing, fine. But like I size it to a level where I'm like, okay, buying that. But if you're like, I get what you're saying. Like, of course, for somebody who doesn't want to buy Amazon, then putting the spread on is a way.
Yeah, I mean, you've got like the cash in the account, and you're just gonna buy it if it goes to that level. So no harm, no foul. But people oversize. They don't have the cash.
I swear, oversizing is the name of the game, because like, here's another thing that happens. Like, if you've sized it correctly, you don't even need to take the shares, right? If Amazon, I'm selling 50% down, like let's imagine some like 5 standard deviation move where Amazon actually goes 51% down, and I start losing. Like I would actually be okay just closing that trade out for a loss, and you only lose the 1%. That the delta beyond your strike is like all that you're losing. So like when I'm selling way out of the money, even when I lose, I typically don't lose by much. But again, where it fucks you is if you've oversized it, then like you're just getting hammered. You're getting hammered by that, and you might be forced to liquidate even before maturity if you've way oversized it.
Yeah, and as somebody who like trades leveraged derivatives for a living, I will say that virtually everybody listening to this podcast should not do what Eric is doing. We like to explore risky stuff on here. It's just kind of what we do. I've lost my entire net worth a few times in my life. This is a podcast for people who don't mind being on the edge and everything. But I will tell you that if you play in these waters, like you're probably blowing up. So
it's like, it's greed management. It's greed management more than it is anything else. Like it's not really like risk management to me, because like my whole setup is like designed to do it in the least risky way possible. It's like the only thing that gets you is greed.
Well, let's close this out with just some basic to-dos for you guys, because I think most of you do risk in the form of you either buy crypto or something that's really, really risky, or you buy options, or you buy or you're trading on leverage, right? I think most of you guys aren't selling naked premium, right? So in all of these instances, the first question to ask yourself on the trade is, how much am I comfortable losing on this trade, right? Step 2 is to figure out where the trade is wrong. And then step 3 is to size the trade so that when you're wrong, you don't lose any more than what you want to put in, right? So an easy way to visualize this is on your trusty trading view chart. Say that you're on Bitcoin here. Say you're like, okay, I think the bottom is in. I think we just put in a double bottom. And now I think we're going to go, and maybe we're going to target this high up here. Maybe we go up here, whatever. I don't know what it is. You're going to bust out this handy dandy projection tool, the long position.
Nice. This is
You're
cool.
going to put this on your chart. You're going to drag the bottom of it to where your stop loss is. Always use a stop loss if you're trading with leverage. Your liquidation price is not your stop loss. Okay. Once you've got that, say you're just entering the trade here. Say you're market buying. Say you're just targeting this high. That's fine. 1-to-1. Very, very cool. If you double click on this trade, you can put in your account size. Say you've got a $100,000 account. I like to use the 100,000 size because I can mentally go up 10x. I can divide it by 10. I can multiply it by 5 because I don't want to come in here and adjust this constantly. So that's what works for me. The other rule I have for people, when you're talking about like how much do I want to lose, how much should you lose is a different question, right? If you talk about how to grow an account and kind of balance the desire to grow with the fact that like losing hurts you a lot, 1% is generally the rule of thumb that I tell people. Risk 1% of your trading account on a trade. If you've got like a YOLO account that you're trying to run up, fine, risk 5%, go for it. But if you start risking more than 5% on a trade, you have math start working against you, right? Because let's use an extreme example, Eric. Let's say you're like, okay, I'm going to risk half my account on every trade. You might be like, okay, well, this is great. I'm going to grow my account super, super quickly. Every time I win my trade, like my account is going to go up by like an enormous margin, right?
Yeah, you better be right.
But if you lose 50% on a trade, how much, Eric, do you have to make on the next trade to get it back?
You have to make double that.
Double it. You lose 100. You lose 50%. You don't get it back with 50. You have to double it to get it back. You lose 75% on a trade. You got to triple it to get it back, right? So the larger your risk, the more sort of asymmetry exists between like your gains and your losses, right? And eventually, you're just sort of mathematically guaranteeing that you blow yourself up, right?
This is an underrated point, by the way. Very underrated point.
Yeah, it's a very important thing for people to understand. So 1% is kind of the gold standard. If somebody's trading a $100 million account, they're probably not risking 1%. They're probably risking like 25 or 50 bips, right? I risk 1% in my account, right? So if you're using this tool, you come in here, you type in your risk, you click OK, and then when you enter the trade, this thing is going to tell you exactly how much to buy. So I got to buy 1.3 Bitcoin here. If I buy 1.3 Bitcoin here, my stop loss is here. I'm going to lose 1% of my account on the trade. That's it. I set the stop loss. I go to bed. I don't have to text anybody to ask what to do when the price is down here in the 80s. I already thought about that beforehand. It's done. It's over. You've taken the trade. You've got the thesis. Now you let the chips fall where they may. This is even easier to do if you're like an options degen. Like if you're an options degen and you're just buying options, whether or not this is a good idea, let's put that aside, right? Your risk is simply what is the premium on the contract, right? Like if you're just long and call options, and it costs you $10,000 for those option contracts, and the risk is that they go to zero, well, that's your risk, $10,000, right? So either you're sizing the options contract so that you're just assuming it goes to zero, and that could be fine, right? That's your max risk. 1% of your account is the size of the contract. You can do this in a different way where you may be buying like deep in the money options and you're not planning on those things going to zero, but that now you've introduced a lot more complexity into your world. Now you're going to calculate exactly how many shares you're exposed to and what your effective drawdown is on the basis of that. That's a whole nother can of worms. I don't recommend doing that. I think you want to be a degen, you want to buy some out of the money calls. That's fine. The premium you risk, 1% of your account, no more. You're trading leverage. Use this tool. You could do this with spot too. You want to trade meme coins or something? Okay, don't even use the tool. Like how much of your account are you willing to risk if this meme coin goes to zero? That's basically your risk with the meme coin. It's not it goes down 20, 30, 50%. It's zero, right? So think about that. And I think with spot buys, you're talking about a crypto portfolio. How much am I willing to risk? It's probably more than 1% for like a spot play. It might be like 5%. There might be some plays you're scattering about your portfolio. That's fine. But the exact number isn't so important as the fact that you think about this. You think about what is the downside. You manage that. You don't blow up. Just don't go to zero.
Well said. And killer tutorial on this tool. I had never used that before, but that's cool that you can just like set the inputs and then it just like gives you the output. It's great.
Yep. This thing is great. It's great. It's a beautiful thing. Anyway, I hope you guys enjoyed that. That was a fun episode.
Nice, man.
Touched on a lot of stuff there. I learned some things. I learned all about preferred stock today. Give me a little trade to think about. Once again, if anybody's listening to this, if you're not in our Discord, you want to talk about these trades, you want to chat with us about anything, we're in the Alpha Pod Discord at alphapod.com. You can join that. It's totally free. And if you want to get these trades from me in real time, along with a whole lot more analysis, you want daily updates on the market, more charts than you probably even have the ability to process, because I'm drawing charts all day, baby. Feel free to check out Magic Lines at magiclines.xyz/IL. You can pop in there for 7 days, see if you like it.
Can I actually read? Can I read a testimonial that I saw in the Magic Lines free channel this morning?
There's in the free channel?
Yeah. So Shkreli was just talking in the free channel, and Feach goes, "I think you're a prime candidate for Magic Lines Premium, sir. Steven has been nailing things. The subscription pays for itself swiftly." From Feach.
Oh, thank you, Feach.
Yeah.
I appreciate that. I like to think I'm worth the money.
You are, brother.
Thank you. Thank you. And thank you to everybody for listening. Appreciate you guys joining us here every week. We will be back same time, same place with another hopefully banger of an episode. Hopefully more longs for you, but who knows?
Yeah, man. And SDSU is in March Madness playing tonight. So wish me luck.
Oh, SDSU, good luck, buddy.
North Carolina.
Good luck, buddy.
Thanks, man.
I'm the Tar Heels.
That's right.
I was a Duke guy growing up, so I'll be rooting for you.
Thanks, man.
No problem. All right, thanks, guys. Thank you for joining us. See you around.
See you.